Uh, my name's Abdullah, and I'll be talking about Chapter 1 in Accounting 217. So what is accounting? Accounting is records of economic events, and it identifies how a company or organization communicates these records with individuals, organizations, or maybe other companies that might be interested. There are four types of financial accounts: income statements, which are also known as profit and loss, statement of changes in equity, statement of financial position or balance sheet, and statement of cash flows. An income statement basically shows the revenues and expenses in the company, and then you subtract them from each other and you'd get the net income or loss. Statement of changes in equity shows the changes in certain components of shareholders' equity for a time period. For example, share capital and retained earnings. These are two components of shareholders' equity. Statement of financial position, assets, liabilities, and shareholders. There's an accounting equation which we use for the financial position, statement of financial position. Assets are equal to liabilities plus shareholders, and they must balance at the end. Statement of cash flows report the effect that operating activities, investing activities, and financial activities have on the company's cash. All of these statements are related in a way. For example, the profit that is shown in an income statement is shown as profit in the statement of changes in equity, and total balance in the statement of changes in equity is shown as total shareholders' equity in the balance sheet, and so on.
Hi, I'm Sonali, and I'll be talking about Chapter 2. So in the Chapter 2, it discusses about the sections of a classified statement of financial position, and those are assets, liabilities, and shareholders' equity. So the assets are the resources that a company owns or controls that will provide future economic benefits. These can be of two types: current assets, which are expected to be converted into cash within 1 year, and non-current assets, which are expected to be converted into cash within more than 1 year. So the common type of current asset is cash, and the common type of non-current asset is long-term investment. Liabilities are obligations that result from past transactions and will result in the transfer of an economic resource. Same as assets, they are also divided into non-current and current. The current liabilities are the liabilities which are to be paid within 1 year, and the non-current liabilities are the liabilities which are to be paid within more than 1 year. And the common example of current liability is bank indebtedness, and the common example of non-current liability is notes payable.
Chapter 3 is analyzing accounting transactions. So transactions must be recorded in financial statements because they are economic events. Analyzing account transactions means examining the effect that these transactions will have on the accounting equation. The second step of analyzing is journalizing these transactions. So when you're creating a journal entry, basically contains all the individual accounting records of increase or decrease in specific assets, liabilities, or shareholders' equity. This is an example of a journal entry, and it must follow this format. So debit, and then the account name, and then credit, and then the account name, and then the cash on the side. All debits must equal all credits.
So normal balance: to account for an asset increasing, you debit the asset account. To account for an asset decreasing, you credit the asset account. To account for a liability or shareholders' equity increasing, you credit the liability or shareholders' equity account. And to account for a liability or shareholders' equity decreasing, you debit the liability or shareholders' equity account.
To account for an expense increasing or dividends being declared, you debit the expense or dividend account. To account for an expense decreasing or dividends declared being reversed, you would do the opposite and you would credit the expense or dividend account. To account for revenue increasing, you credit the revenue account, and you do the opposite for when you're accounting revenue decreasing, and you debit the revenue account.